With a double-digit yield and exposure to some of the strongest names in North American energy, Hamilton's EMAX has quietly become a standout for income-focused investors. Hold on to your seatbelts, folks. This is going to be a good one. Energy has always been one of those sectors that investors, they like to keep an eye on for sure. The dividends tend to be on the stronger side. The cash flow, it's fairly predictable. And when oil prices cooperate, oh boy, the upside can be rather impressive. However, most energy ETFs either give you pure exposure with modest yields or high yields with very limited growth. Finding something that blends both has always been, it's been a wee bit on the tricky side. Hamilton's EMAX may just fit the bill for income-focused investors as they satisfy their need for yield with the potential for some modest growth on the side. With this ETF, you get a basket of large cap North American energy companies that include, of course, the big integrated producers, the refiners, and some of those service giants. EMAX then layers on a covered call strategy to turn that sector strength into consistent monthly income. And we're not talking mild income here. We're talking about a double-digit yield paid monthly from a sector that has shown surprising resilience over the last couple of years. This is an ETF that can potentially be a great fit for an income or a hybrid growth income strategy. And if energy sees a rebound in 2026, we could, we could be looking at some nice growth in addition to that yield. Looking ahead to 2026, we do have a growing case for a potential energy sector recovery. With global inventories tightening, new supply struggling to come online, and North American producers focusing heavily on efficiency and profitability, the setup for energy prices could be more favorable than what we saw through 2024 and 2025. If that momentum returns, EMAX could benefit not just from its hefty yield, but from renewed strength in the underlying energy stocks themselves, giving income investors, well, a good slice of growth upside at just the right time. Of course, we also must acknowledge the trade off that comes with any covered call strategy capped upside. If energy does stage a strong rally in 2026, EMAX won't capture the full explosive move the way a pure equity energy ETF would. The call premiums, yep, they sure do boost your income, but they do also limit how much of that breakout EMAX can participate in. That's not necessarily a negative, it's simply the design of the ETF. You're trading some potential upside for a higher, more stable stream of monthly income, which, it's a trade many income-focused investors are absolutely perfectly happy to make. A sub to the channel is the best way to keep your pipeline full of future content. I think it's time to jump right in and take a quick look at the fundamentals. EMAX started trading in February of 2024, so we don't have as long of a runway as I would like in terms of that performance math. Nonetheless, we can still get a clear picture of what this ETF can do and get a snapshot of its overall potential. So, without any further ado, let's do this. We will, as usual, we'll start with a little bit of surface data. So their current value at the time of recording, that's coming in at $14.30, and they have an NAV of $14.27. Those net assets under management, 324.5 million. And according to Yahoo Finance, their average volume is coming in at 74,326. Looking at their fees, we get a management fee of 0.65%. Management expense ratio 0.80%. So far, so good. Let's drill a little deeper and take a look at what this fund let's see what it has in its basket. So when we peer into that basket, their top 3 holdings include Halliburton with a 5.9% stake, SLB Limited with a 5.3% stake, and Phillips 66 with a 5.3% stake. The top Canadian performer in their basket is actually Canadian Natural Resources with a 5.0% stake. I will point out, this ETF is heavily slanted towards the United States. In fact, 80.7% of this portfolio is US energy companies. Canada makes up the other 19.3%. I do like the diversification, though I wouldn't mind it skewed, a little bit more to the Canadian sector. But we'll take what we have. It's still not bad. Let's turn that last page and look at the dividends and those returns. When it comes to dividends, they have a yield of, and I said double digits, 13.17%. That does translate into a monthly dividend of 14.2 cents per unit. Now, let's change things up a tiny bit here. So I really think that to get a better handle on EMAX return data, well, I think we need to set a benchmark. And we're going to do that by looking at the price of West Texas Intermediate, or WTI. So in the last year, WTI significantly struggled, and in fact, has a return of negative 15.93%. Oh boy. I think it is clear that this ETF will not have a positive return in the last year. So, looking at their return, yep, that return on investment 1 year, negative 11.18%. However, when we do factor in those total returns, we do get back to the positive side of 0.49%. This is actually not as bad as I was expecting, as they did better than WTI as a benchmark. However, this is not an apples to apples comparison, as most of the companies they hold are involved in a lot more than just crude oil. I did also look at IGE. This is a US ETF from iShares that has a more similar mix of holdings, and they returned 3.15% in that same time frame. This is what I would expect after some loss of upside potential on the second half of the last year. Speaking of that second half, since Trump's Liberation Day in April, this ETF has been on a nice recovery and has grown from the Liberation Day low, a nice looking 11.81%, or once we factor in the dividends, 21.32%. In that same period, IGE had a total return of 21.09%. EMAX, well, they did win that small battle, and it really does show the potential in this ETF, especially if we do get some sector recovery in 2026. Okay, I think I think we've seen enough. I think it is time for that final verdict. When you put all the pieces together, EMAX tells a very clear story. This is an ETF built for income first and growth second. And in a year where oil struggled and WTI was down nearly 16%, the fact that EMAX still managed to scrape out a positive total return, it it does say a lot about how well its covered call strategy cushioned the downside. It didn't keep up with a pure play benchmark like IGE over the full year, which is exactly what you would typically expect. However, when the sector experienced steady yet mild recovery after Liberation Day, EMAX held its own impressively, even edging out IGE over that same recovery period. I believe the mild part is important in this part, as they would not have lost as much upside as they would have in a stronger bull run. Nonetheless, and this highlights what this ETF is designed to do. It's not here to shoot the lights out in a full-blown commodity rally. It's here to deliver big, steady monthly income while still participating in enough sector upside to keep long-term returns moving forward. If 2026 does bring a broader energy recovery, EMAX is positioned to capture a respectable share of that momentum with the added benefit of a double-digit yield the whole way through. At the end of the day, this is an income ETF. It's not the right tool for maximizing pure upside, but it was never meant to be. EMAX is a yield machine with real potential attached to it, and in the right portfolio at the right size, it can absolutely be a productive part of the income-focused strategy. If you are interested in EMAX, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on total return income plays. Thank you for watching, and I will see you in the next video.